and welcome to today's UKGCC Quarterly Tax Dialogue Series. My name is Christiana Osei-Mensah, an Associate Director with PwC Ghana, and I am going to be your moderator for today. This webinar is organized by the UK-Ghana Chamber of Commerce. The Chamber exists to further the business interests of its members across Ghana and the UK. You are welcome to join the UKGCC if you wish to take advantage of the support the Chamber has to offer. You can log on to their website to learn more about the Chamber and the joining requirements. So our topic for today, as you can see on the screen, is tax residency rules in Ghana, preparing multinationals for compliance. I must say I have a very well assembled panel here, and I would like to introduce them. Thank you for graciously agreeing to spend a couple of hours with us to digest this topic. So in no particular order, I'd like to first introduce Mr. Daniel Noah. So Mr. Daniel Noah is currently the head of the tax policy unit at the Ministry of Finance. He is a career public servant with over 33 years of experience in tax administration and tax policy. His last assignment prior to taking up the position at the ministry was as a monitoring and evaluation manager with the GRA. Welcome, Mr. Noah.
Thank you and good morning to everybody.
We have apologies from Mr. Edward Appington Jamra, the Commissioner for Domestic Tax and Revenue Division of the GRA. He would have loved to be part of the discussion, but could not make it due to matters beyond his control. So in his stead, we have Mr. Michael Edu Owusu. Michael is the current head of the CRS Compliance and Enforcement at Exchange of Information. Michael holds a master's degree in business administration and a diploma in taxation. He has a deep understanding in the area of taxation after having worked at the operations department of the GRA as an assessment schedule officer, a field tax enforcement officer, and a tax audit officer. Welcome, Michael.
Thank you and good morning.
Our next panelist is Yvonne Nikwe from Minka Premo Osei Bonsu, Bruce Catlin and Partners. Yvonne is the head of the accounting and taxation department of the firm. Aside overseeing the accounting and taxation aspect of the firm, she also gives tax advice to the clients of her firm. Welcome, Yvonne.
Thank you, Christina, and good morning to everyone.
So, last but not least, we have Godwin Kofi Matacho. Godwin is a senior manager for international tax and transaction services at EY Ghana. He has over 13 years experience in the provision of multifaceted advice to both local and international clients in taxation. He specializes in the provision of tax compliance, tax advisory, tax audit and controversy, tax policy, and international tax and transaction services to his clients. Welcome to you to Godwin.
Thank you and good morning, everyone.
Okay, thank you, panel, once again for agreeing to be part of this discussion this morning. So just a little bit of background. Tax residency is an important aspect of taxation for both individuals and entities, determining which country has the right to tax their worldwide income. So our discussions today will be focused on corporate tax residence. We do appreciate that we have different types of residency, but today our focus is on corporate tax residence. For most countries, including Ghana, corporate tax residence is primarily defined by the tax laws. The way we undertake business has significantly changed, especially after COVID. Remote working has come to stay, and this creates many tax considerations, which includes change in corporate tax residency. Technology has its role to play as well. So technology has made it possible for businesses to operate from anywhere in the world. For this reason, it is very important that businesses or multinationals always reviewed their activities for every year of assessment to confirm their corporate tax residence for compliance purposes. So usually, once a company is deemed tax resident in a specific jurisdiction, you expect that, like maybe in Ghana, like in this case, Ghana, you expect that they will have some compliance requirements. And these compliance requirements will include tax payments and the filing of returns in accordance with the applicable local laws. So going into our topic further, under Ghanaian law, the test for corporate tax residence is incorporation or the exercise of management and control in Ghana. So some of the questions that comes to mind, which my panelists will be providing some clarity on, are where do we situate external companies, and that is branches and liaison office, in this discussion? From DRA's perspective, what is their guidance on what constitutes the exercise of management and control? This should give multinationals a fair idea of the activities that are likely to trigger corporate tax residence from the exercise of management control in Ghana. What are the tiebreaker rules where a company has dual corporate tax residence? Another question which comes to mind is compliance. So I did share earlier that usually once a company is deemed tax resident, there are or maybe compliance requirements in accordance with the local laws. So this morning, our panel will throw light on the scope and level of tax compliance expected, how companies are expected to comply in circumstances where they are tax residents in Ghana and their home country. Can they register with the GRA for compliance purposes without having to incorporate or register an external company here in Ghana? We cannot talk about corporate tax residence without talking about double tax agreements. So for double tax agreements, we would definitely want to know, because we know Ghana currently has about 14 double tax agreements in place. How does our local law interact with the international agreements signed in determining tax residency of companies in Ghana? How can a company assess the treaty benefits under the double tax agreements? This is in reference to the practice notes on obtaining double tax relief under the Income Tax Act. It was recently signed on 24th March 2024. Then, where there is no applicable double tax agreement, what is the recourse for a company that has dual corporate tax residence? Finally, we want to know the challenges, both from the multinationals and even also from the administrator perspective, GRA. Many treaties are currently moving away from place of effective management and are currently implementing the mutual agreement procedure clause. What are the challenges when it comes with this mutual agreement procedure? So these are some of the questions we will be answering. My panel will be clarifying for us during this session. So I will start with Mr. Edu Owusu from the GRA. He will kickstart the panel discussions with a presentation from the GRA's viewpoint on the topic. Please continue to send through your questions and comments in the chat box, and we will do our best to respond to them accordingly during the discussions and also during the Q&A session. So at this juncture, I will hand over to Mr. Edu to take us through his presentation from the GRA perspective. Over to you, Mr. Edu.
Thank you, Christiana. And once again, good morning to our cherished participants and also fellow panelists. Before I start with my presentation, let me attempt and share my screen with you. So I'm speaking on the topic tax residency rules in Ghana, preparing multinationals for compliance. And this falls in line with GRA's drive towards tax transparency, good governance, and voluntary compliance. The presentation will be on three main thematic areas: introduction, legal regime, and tax residence status. And we will dwell on that of a company. My objectives are to ensure that participants would understand the determinants of tax residency in Ghana. I will try and increase awareness about the key regulations as regards tax residency in Ghana, and also discuss some of the common challenges and attempt to explore best practices for overcoming tax residency issues faced by multinationals in Ghana. And I believe we'll have adequate time to dig deep into these areas and to enhance the understanding and tax compliance. We all know that tax is a creature of law, and without a legal regime, no taxes can be duly collected. And in Ghana, our emphasis is on the Income Tax Act 896, which also take its strength from the Constitution of Ghana 1992, specifically Section Article 174, Sub 1 of the Constitution, which specifically states that no taxation shall be imposed otherwise done by or under an authority or an act of parliament. Ghana in the past, up until 2014, had been taxing residents based on territorial concept of taxation. So we have various enactments that have been operated over the years, with the last one being the Internal Revenue Act 2000, Act 592, which was changed in 2014, and in 2015, Act 896 was promulgated by an act of parliament, and it adopted the worldwide or global taxation approach, where income for a resident person will be taxed based on both the local sources and the foreign sources of that person. And under the Income Tax Act, the strength is on Section 3, Section 103, 105, 111 of the Act spells out the guidelines to enable taxation on worldwide approach to be pursued adequately. The Act tries to define what a person is for tax purposes, and in it defines a person to include an individual, a company, a trust, partnership, or any other forms of arrangement specified under a tax law of a country. And it covers some criteria which may include a person's domicile, residence, place of incorporation, place of management, or any other conditions that would be spelled out under an act. And in Ghana, Section 133 of the Income Tax Act defines a person to include an individual and an entity. Today's presentation will be centered on an entity and will drill down to that of a company. Section 101 also provides the criteria for determining who a resident person is for tax purposes in Ghana. And in the area of a company, the law stipulates that a company that is incorporated under the Ghana law, that is Companies Act 992, which was incorporated in 2019 under the Office of the Registrar of Companies, is deemed to be a resident person or a resident company for tax purposes in Ghana. More so, it extends the definition to cover the area of management and control of the affairs of that company or of any company to the extent that it is exercised at any point in time in Ghana during a year. And through this arrangement, the Income Tax Act establishes what is termed as a permanent establishment or a PE. When we look at the incorporation, it's a quite straightforward thing that to the extent that the entity or the company is incorporated and gazetted under the Ghana law, it is deemed to be taxable and should be filing its taxes and returns in Ghana. However, where the area that most misconceptions exist is under the management and control issues. And you review or a review of various literature will take us to the domain known as place of effective management or a place of management. And literature defines it differently. I would attempt to look at those definitions in general literature and then dive into the Income Tax Act and treat how it looks at a place of effective management under the PE so established under the Income Tax Act. Place of effective management is where key management or commercial decisions of an entity are necessarily conducted. And in general, we'll be looking at where maybe meetings of the board of directors or equivalent body are usually held, places where the CEO or other senior executives usually carry out their activities. We may also extend it to look at place where the senior day-to-day management of the entity is carried on. We would not also overlook place where the entity's headquarters is located. The place of which the country's law governing the legal status of the entity is also taken place. So technically, this will be looking at the country under which the company is incorporated and technically taken care of under the Income Tax Act. The place where its records are also kept would be also one of the modalities of defining where effective management and control of an entity may be taking place from the perspective of general literature. However, you come under the Income Tax Act and the route is through that of the creation of a permanent establishment. And Section 107 of the Income Tax Act states specifically that a permanent establishment is an entity and it is separate from its owners and is subject to tax under Section 1 of the Income Tax Act, the same manner as a resident company will be taxed if that permanent establishment is ruled to be a Ghanaian permanent establishment. And 107B also states that in accordance with section 1112, a permanent establishment is exempt from tax if that permanent establishment is situated outside of Ghana. The income of a permanent establishment would then be determined, and it will be computed as such that the permanent establishment and its owners are separated, but they are considered to be in controlled relationship. So the activities of the permanent establishment will be controlled by the controlling persons or the owners or the shareholders, whether in this case they may or may not be resident persons, depending on which type of permanent establishment that we are looking at. And also that the permanent establishment is considered to be resident in the country in which it is situated, An activity of a permanent establishment is deemed to be the activities that are conducted for and on behalf of the owner, or it is conducted by the owner through the permanent establishment in Ghana. So to the extent that this rule applies, the entity will be considered to be a PE, and the tax rules would apply accordingly. In defining a permanent establishment and its activities, the Income Tax Act will look at various activities that would have been carried out within the confines of the Income Tax Act or within Ghana. And once it satisfies these standards set in the Income Tax Act, then it is presumed to have been conducted by a Ghanaian permanent establishment. And we look at when the owner employs an individual who is resident in Ghana to carry out an activity on their behalf, a PE is established. When the owner makes a sale of trading stock of the same or a similar kind as those sold through the permanent establishment, that activity will be deemed to have been conducted by the PE created by that person. And other business, any other business activity of the owner, which is of the same or similar kind as that effected through the permanent establishment, so long as the controlling person carries out this activity within Ghana, it is deemed to have been conducted by the permanent establishment in Ghana. A distinction would have to be made between a Ghanaian PE and a foreign PE. And a foreign PE, by definition, is a place of business for or of a resident person situated in a foreign country or jurisdiction where the business conduct continuously for at least 6 months, a business activity, but excludes any place at which only activities of preparatory or auxiliary nature is conducted. So an entity duly registered in Ghana may operate a subsidiary elsewhere, and to the extent that its activity and the time duration meet the standard that I just made mention of, the PE will be deemed from the Income Tax Act of Ghana as a foreign permanent establishment. And in the case of a Ghanaian PE, we are looking at any place within Ghana where a non-resident person carries on a business or that is at the disposal of that person for a business purpose. And also any place in the country where the person has or is using or is installing substantial equipment or substantial machinery for business purposes. It also extends to a place in the country where a person is engaged in a construction, assembling, or installation project for a period of 90 days or more, including a place where a person is conducting supervisory activities in relation to that project within Ghana or within the jurisdiction. And also the provision of service in the country. So any sort of services that is provided and enjoyed within Ghana, it is deemed that a Ghanaian permanent establishment has or have been created. A place in the country where an agent would or is performing any function on behalf of a business or on behalf of a non-resident person, that activity or that relationship would also be deemed to have created a Ghanaian permanent establishment. So this is by way the parameters within which the income tax would target a company for taxing purposes in Ghana. Now, some school of thoughts or some theories would dwell around what is known as dual residency in the case of companies. We realize that some concentrate on a company being considered for tax purposes based on registration by the registrar of companies of that jurisdiction. In some jurisdictions too, it will concentrate on place of control or effective management. Jurisdictions are where they would consider the incorporation doctrine and also effective management and control. On the other hand, where a jurisdiction dwells on registration, then it will overlook the effective management and control theory. This creates different status. And in Ghana, a vacuum or a creation can come up where an entity will fall in between these two lines of being possibly to be pronounced as having a dual residence status. And I also believe a country like UK dwells on effective management and control. So if an entity is registered in UK and has its effective control being done or implemented in Ghana, then technically it will not be considered as tax resident in UK. However, by virtue of Ghana's law, it will target that entity. So in this case, from this perspective, a gap will be created. These has been issues and various court rulings has come up over the years on them, to the extent that the OECD in 2017 amended Article 4743 of the Model Convention and its commentaries regarding dual residency status of entities, with the exception of that covering individuals. However, in the case of other persons, it's been amended. For a person to benefit from a treaty agreement, the person should either be a resident person in Ghana, and also that is in the case of Ghana, and should also be a resident person for the treaty partner in case the person want to enjoy from the treaty benefits that have been negotiated by the originating country or jurisdiction of that taxpayer. And the person, the person will be the beneficial owner of the income in context and should have also met or satisfied any limitation, costs, or benefits that is enshrined in the negotiated agreement, or should also be entitled to the benefits that have been negotiated in the treaty wherever or whichever is applicable. There are conditions that would have to be satisfied before a person would be able to access treaty benefits. For a treaty to be assessed by a taxpayer, the person should satisfy certain determined under law and regulation. And I stated that the taxpayer should be liable to pay tax in the jurisdiction that he references as his or its tax jurisdiction. And necessary checks will be conducted by the tax authority before that taxpayer will be honored. And we also have to ensure that the income in question is not exempted under the Income Tax Act of Ghana. And the tax in question should also have been satisfied under the DTA that was agreed upon between Ghana and the jury. The benefit is also specifically not to be excluded that has been negotiated by Ghana with the treaty partner. And the treaty benefits should also be claimed within the stipulated time. And the standards require that if the income that the tax relates was earned in maybe this year, then it should be claimed only after the close of the year and not any other year, and also to be specified under tax laws. Yes, so having considered the reason for treaty negotiation, the conditions and the benefits, we are going to look in depth as up to what type of benefits that are available once a treaty is signed. And some of them include relief from double taxation, in which case the tax credits that a person might have been made to pay in a jurisdiction would not be will be granted to the extent that that income had been assessed in the actual tax resident or the tax jurisdiction. And in doing so, emphasis is always laid that double non-taxation should be avoided. DTA also exists to ensure that withholding tax rates, services fees from for non-resident persons are reduced, at least to the extent that it has been negotiated under the treaty. Treaty negotiated also extend benefits to some foreign airlines and shipping companies, or some are sometimes exempted depending on how negotiations are concluded. And under the Income Tax Act, Section 7, there is an exclusion or some exemptions for shipping companies and airlines that operate in Ghana and have reciprocal relationship with Ghana on that same issue. Treaty negotiated also accords taxpayers the opportunity to enjoy from competent authorities mutual agreement procedures where issues that are not resolved could be discussed amicably by competent authorities to the extent that it will not go against the taxpayer. And this is a benefit that would inure to resident persons on whose behalf treaties has been negotiated for. And under double tax agreements, non-discrimination is also achieved. And in this case, similar treatment under a jurisdiction's tax law will be applied to non-resident taxpayers without any discrimination. So I believe this would satisfy us in our attempt to look at tax residents for a company in Ghana under the Income Tax Act. We hold on for Q&A to fine-tune and to clear any rough edges lingering on our minds going further. Thank you. Christine?
Thank you, Michael. I think at this juncture, let me quickly give opportunity to my other panelists to share their initial comments very briefly on the topic and on what you have shared, then we can dig in straight to the discussions. So maybe from the multinationals perspective, Godwin, what's your initial comment regarding the topic and Michael's presentation?
All right, thank you, Christiana. Yeah, the topic of tax residence for multinationals is very key and is something that we've been grappling with. You did mention initially in your introductory remarks about external companies, how their tax residency is determined. How we see the practice is that for a multinational non-resident person doesn't know what an external company is. So most of the time, their intention is to set up either a branch, a liaison office, a representative office, or whatever name that they give to them. And they do not expect to have any tax compliance requirements in Ghana as a result of setting up such lean structures where they may just have one person or two in the Ghana office doing some promotional activities or representing their interest in Ghana. So it is something that I would want Mr. Noah and Michael to throw more light, because they've always been on a collision course with the regulator when the regulator requires that these entities also register for tax, file tax returns in Ghana. And the explanation has always been that this is a cost center. They do not generate any income in Ghana. Basically, it is the head office that finances their activities in Ghana here. So if Mr. Edo-Owusu and Mr. Noah would throw light as to what basis under law. Mr. Edo-Owusu has already indicated the place of incorporation and then management and control, and has linked it to permanent establishment. But what is not clear is where these entities, when set up, they fall into. Is it registration? If we say registration, is registration the same as incorporation? Is that how the regulator sees it? Or they fall under the place of management and control and all that? So that it will be great if we get further clarity on that.
Thank you, Godwin. So we'll hold on to that question. Mr. Noah and Michael, please note that down. I will call Yvonne to also share her perspective, especially considering what Godwin just shared. So if we are looking at the Companies Act, incorporation, what does it mean in the Companies Act? Because we've already established that the test for corporate tax residency is incorporation and then place of effective management. So incorporation, what do we have in the Companies Act? Yvonne. Okay, I think we've lost Yvonne. Then I'll Mr. Noah, would you want to take that question?
What does the Companies Act provide? Christian, is that the question?
If you can respond to Godwin's question in respect to an external company.
Okay.
In relation to the test for corporate tax residency.
Okay. Let me start with that. I'm going to make a general statement. The issue of an external company, and it becomes very interesting because under Ghana law, register as an external company, basically you've created a P, and so the rules that govern permanent establishment will apply to. And so it becomes interesting. I would say there are several tests that will be put to it. What is the person doing? Is the person the general agent? The person specific? Various tests take place. So it's not, should I say, a one-size-fits-all answer. Would apply all the tests. Have you created a permanent establishment? If you have, based on the rules that are there, then you fall within the person who has to file a return and make some payments. Now, we are talking about income tax, but sometimes some of these rules are interesting when we move into the other laws, for example. Let me give a typical example. If you're providing services and you are non-resident, but you provide services in Ghana, then you are required to register for VAT, which is just an aside, by the way. But when it comes to income tax, as we said, once these rules are established, you have a permanent establishment. Then it determines how you be treated. Now, there's one other thing, especially when it comes to services, where the supply of goods and services, where anybody who signs the contract is required, and that one is basically for residents, it's not for residents. Anybody a resident who signs any contract for the provision of service or the supply of goods is required to inform the Commissioner General. Commissioner General will look at these things and determine the residency of that person, that external person. So if you're a multinational and you're supplying items to Ghana, now you don't sit and determine that. I think Godwin mentioned somebody believes that, oh, I'm resident or non-resident. That provision in the law allows you to go to the commissioner and determine your status. So I'm moving from where God is, a person does puts in a branch or chooses just a sales office or there's some. Once there's some supply that the person do to Ghana, or there's somebody who's also receiving that supply. There are two parts. The person receiving the goods, receiving the service, must inform the commissioner, so that the commissioner can determine that whether the supplier of the service, who is non-resident, is subject to tax in Ghana, whether the person is trading in Ghana or trading with Ghana. Those things that need to be determined. And there are various items we'll look at, as mentioned: place of effective management, place of registration. So you registered here as an external company. What are you doing here as an external company? Are you providing, what kind of services are you providing? And I think in doing this, we have to touch on individuals. Somebody mentioned in the Q&A, asking that, how about individuals? Because sometimes the company sends somebody here. So the individual, his income, his earning, is it subject to tax in Ghana or subject to tax? How many days has the person stayed in Ghana in order to be able to pay the tax? And let's know that, and I think there's an important thing I should state here. Your residency determines how you are taxed. It doesn't change your liability to tax. I think that's a very important thing you should understand. A residency determines how you are taxed, not your liability to tax. And that is why we use if we are not sure, we use the mutual assistance program, assistance arrangements to determine where you should pay the tax. Sometimes somebody has that I won't pay tax here, I won't pay tax there. No, pay the tax somewhere. But it just determines where you are paying the tax, whether you are paying the tax to Ghana or you are paying it to another jurisdiction. I think that's an important thing also. And that is where, if we don't have a treaty, then the foreign tax credit system comes into play. Let's move that. If we have a DT, it will be determined based on the double tax. If we don't have a DT, you can still we'll still determine how you are taxed. But then you get what we call the foreign tax credit. The foreign tax credit allows you to set up whatever tax you paid out, because we require that you file here and pay tax here. That's what it is. So generally, the tax that is paid is not lost. Sometimes that's the problem. Now, I'm answering Gordon's question. Sometimes the tax paid is assumed to be lost. So the person starts fighting with you because he feels that he's going to pay the tax in his country. So he's also going to pay it here. And that's where the problem comes. But where the foreign tax credit issue becomes is understood, it reduces those tensions. So it's one of the things which I think on this platform has been very clear. It runs in two different ways. There's a foreign tax credit, which is a tax credit against the tax. Then in some jurisdictions, it's given to you as an additional expenditure. So in somewhere like the US, for example, if you pay tax in Ghana and you go there, you allow the tax as a deduction as an expense, not as a deduction against your tax. So it means that you're going to pay the tax, but there's a lower amount. In countries where the tax credit is a set of, like Ghana, where your tax is reduced by that, or in some other countries, what it means is that the tax you are paid here are permanent on your, whether the representative or whatever you paid. When you go to the other jurisdiction and you file your returns and your tax is determined, you get a credit for the tax that you paid in that, up to whatever tax system. So if there's a country which has 35% and Ghana is 25%, you get a tax credit for the 25% you paid. And so that means that you pay only the 10% difference. So as I said, I want to go to the source of Gordon's question, because the issue is more being taxed twice. So when that determination has been made, then it determines where you pay the tax and the tax credit you will get. That's the long answer to the short question.
Okay, thank you,
Mr. And I want to say, make a quick statement. I think I wanted that there are a lot of things happening on the international tax team. There's the UN Model Convention, which has been revised. The revision will be published. There are a few things that are changing there. There's a discussion going on about international tax cooperation at the UN to set up a framework convention on tax cooperation, and also to set up develop some protocols on how the framework will operate. And so I think that this discussion is timely. It gives us a foundation of what is this. In the next few years after these things are completed, we'll get a good idea too of what we should expect. We don't expect the rules to change too much, but then the idea would be to try and iron out a lot of these double taxation issues, so that people can feel a bit more comfortable, especially the multinationals. They will have one set of rules. Ghana will not have a different set of rules for them. UK will not have a different set. USA will not have a different set. There will be generally some balance in the rules so that they can be comfortable dealing with all of us.
Thank you. We will look forward to that, and we hope Ghana will be one of the first adopters. Okay, so Yvonne, I think we lost you. So I wanted you to throw light from the Companies Act perspective when we talk about incorporation and how that is different from like external companies.
Hi, Christine. As you said, there are two categories as the company being incorporated in Ghana, then effective management. Place of management and control. But most questions have come up regarding registration of external companies. So as the panelists have already discussed that, I'll go straight to the incorporation and then the registration for external companies. So when you look at the Companies Act, when it comes to registration of companies, the processes are outlined in the Companies Act. And briefly, because we don't have much time, most of the summary is we need a minimum of 2 directors, you need a secretary, you need an auditor, and those people must give their consent regards the incorporation of the company. You also need the shareholders to complete their beneficial ownership, okay? And where there is any form of foreign participation, you should look at registration with GIPC, and then you can also go to the free zones. After you've complied with all this registration with RGD, then you'll be issued with a certificate of incorporation. And when you receive the certificate of incorporation, then you can commence business in Ghana. Then you also do your part to register with Ghana Revenue Authority in terms of your tax compliance. When you look at the Companies Act, regards external companies, that's section 329 of the Companies Act, defines an external company as a body corporate formed outside the Republic, which has an established place of business in the country. I think Mr. Michael spoke a lot about what constitutes a permanent establishment. And if you look at the established place of business per the Act, it spoke about branch management, and Mr. Michael spoke a lot about it, so I wouldn't go there. But most of the things that external companies require, the Act speaks about a local manager and a statement of notice delivered to the registrar. Also, you need all the notarized documents from the foreign company. So I'll say basically that's what the law says in the Companies Act regards registration. For the place of management and control, as I said, Mr. Michael has already elaborated on it, and I don't want to take all the time in explaining that.
Okay. Thank you, Yvonne. So, Mr. Noah or Michael, based on what you've shared, I guess from the GRA perspective, when we are looking at management and control, then we are more like looking at it from a PE perspective, because based on what Yvonne shared, incorporation is totally different from the external company, because we have the external company that are incorporated in another country. They are just registered here. So by virtue that they have a place of business here, which end up creating a PE, so that is closely linked to the reason why we say that they have to file, pay taxes, and comply.
Exactly. So in my presentation and in considering the type of activities that should take place before an entity or a company will be deemed to have created a Ghanaian PE, I made mention that beyond the creation of a local money act, it talks of the recruitment of a resident person to act on behalf of the non-resident company. And that is the version of the local manager in the Income Tax Act. There are some companies that might not have gone to the office of the registrar of companies to regularize. However, they will be within the Ghanaian space conducting business. And there are 2 other provisions under the definitions that I gave. That is under 108 sub 3. It says that if a non-resident person trade in a stock in any form that the PE that has been established to conduct an activity on their behalf in Ghana, to the extent that the non-resident company carries out that activity, it will be construed to have been conducted in the name or in the capacity as a permanent establishment, and by extension, a Ghanaian permanent establishment. So these are within the legislation to ensure that there are no gaps for any company to run through without honoring tax obligations in Ghana, I will say for now.
Okay, thank you. Godwin, any follow-up from your end?
Yes, Christiana. So I would also want us to look at the management and control bits, because in most instances, as we're looking at the double taxation agreement and how we apply them in Ghana, there's of dual residence, because Mr. Noe did indicate that they are trying to harmonize this across various jurisdictions so that there will not be different considerations of what constitutes a resident company in one jurisdiction to the other. But I want to know, of course, we did mention the permanent establishment, but when we are looking at, for example, control, are we looking at just saying that because you have a local manager in the case of an external company, but if it is not an external company and it is just a company incorporated elsewhere, but that has got, say, the chief executive officer or maybe the group tax manager or the group accountant, Mr. Do also did indicate some of the elements of management and control. Such an entity, even though hasn't registered in Ghana here and is not conducting business in Ghana, are we looking at bringing this entity within the taxing jurisdiction of Ghana because it has got this key management personnel in Ghana?
Should I take it or Mr. I should take it?
You can go ahead.
Okay.
Michael,
Yeah.
you can take it.
Michael, go ahead.
So in terms of control, let's attempt and answer these questions. That in what form is this entity manifesting itself in Ghana? Is it through an agent that it has permanent control over, or it has, how does it bring its services for it to be consumed here? And by the definitions in the law, where an agent is recruited and there is absolute control over the agent, then the PE status should have been created and should be subjected to tax accordingly. Because for the entity to operate within Ghana, there should be a medium. There should be a medium. And by extension, depending on even the IT infrastructure that it is conducting it through, there are enactments to address that situation. So there's no situation where there will be a void that an entity would conduct an activity here and should not be subjected to tax. Maybe Mr. Noel will top it up with some other analysis. Thank you.
Okay. As I mentioned earlier, it's interesting because you can't have, though the rules are there, you still need to look at it on a case-by-case basis. One interesting, if you pick our treaty with Denmark, for example, and you want to look at the permanent establishment as it's put there are a lot of things that you not find in some of the details. You not find in some of the other some of the other treaties that we have. Qatar is very detailed, and so generally that's why that the general rule is there, is that if any such situation happens, you go to the Commissioner General, you go through the issues Michael is talking about, and we'll apply each of them and look at it. Because, for example, if there's a supply to them, and though you are person trading, and it's through a general agent, not a specific. You don't even have some specific presence here. We will not say it any company because it's through a general agent, not respect. So you will not have what we call a permanent establishment. But then, aside of that permanent establishment, is it possible that the supply of whatever is being done is done in a way side that you want to avoid some tax? So those are things that will be looked at in terms of it, whether the arrangement you have is an avoidance arrangement or is a general arrangement which we are just going on your business and there's no cause for it to worry about it. And that's when the person is registered, it makes it easier because the person is formally known. The structures are there for you to determine. Okay, so the management, the people who are managing, they're the ones who are controlling the operations of the company or the entity, even though the entity is not resident in Ghana, it's not in Ghana. But the people managing it, if they are residents in Ghana, the ones who are controlling everything the company does, it will be taken to be a Ghanaian company. And the only reason why you is elsewhere because you want to avoid tax. And in that case, we'll look at it and make sure that the amount is here. But if it just happens that there's one person here and he doesn't even take decisions that affect the company, then you are not looking at the effective management here. But the question is that one person who's here representing, does he create a permanent establishment or not? So it's a number of factors you look at. And it's always important to talk to the GRE of these things, not to assume, so that the case is there, the items are made very clear. Then there's a determination made on it, so that you also can hold on to that determination that this determination has been made on what I'm doing. The commissioner has made this determination, and so it makes it easy for everybody. Otherwise, we'll be subject to all the interpretations. The multinational has interpreted it in his own way. GRE is interpreted his own way. Because the two are not talking to each other, there's that gap. But once that communication goes through, it's determined for that entity. Everybody is happy.
Thank you, Mr. Noah. I think let's maybe talk about the compliance bit now. So once it's established that you have corporate tax residents here, and especially with the example that you gave, what are the tax types that we are looking at here?
Is it to me or to Mike?
Yeah, maybe Michael.
Okay.
Mr. You can also top up if there is more to add.
Okay. So let me start by distinguishing between an entity that should be paying final withholding taxes in the case the company is a non-resident type. So if we go through the analysis as I earlier intimated, and the conclusion is that the entity does not fit the definition of a Ghanaian resident taxpayer or a PE, a Ghanaian PE, then it will suffer final withholding taxes according to the section 116, the rates applicable. Now, if it becomes a Ghanaian PE, then it assumes the nature and character of a normal or a regular company that is taxed in Ghana. And we will be then looking at the various sectors and the applicable rates. But the general tax rate is 25. However, depending on whether you are in the hospitality industry or whether you are in the banking industry, you would be having some concessionary rate. So in terms of compliance, the entity is required first to register with GRA and then file returns. If it is beginning the registration, then a self-assessment would also be needed to be filed. A self-assessment return would be required, and the various quarterly tax payment would have to be honored as well. At the close of the year, then annual returns will be filed, and the returns are filed 4 months after the year of assessment. Now, after looking at all the rates, DTAs will come in to also abate or to reduce the rates based on the negotiated treaty agreements. And we would then proceed thereof to ensure that there is full compliance of the laws. Thank you.
Thank you, Mr. Noah. So following from that, and I think Godwin and Yvonne also mentioned that earlier. So if you have triggered the corporate tax residence, and then in this case, we are looking at the extensive compliance where you have to pay corporate income tax, you have to do all of the others. So my question is, if it's just a one-off, because every year you are expected as a business, if you are operating all around, you should check if you have triggered the corporate tax residence. So if it's just a one-off, in terms of the compliance, if we look at the registration process, you are expected to show some form of registration with the under the Companies Act. Is there a way that a non-resident who has triggered a PE or who has corporate tax residence here in Ghana can file and pay tax returns and pay taxes without necessarily having to register with the under the Companies Act?
Yes. In conducting our compliance activity, we may come across a company that is carrying out commercial or economic activities, all right, but might not have gone to the Registrar General's Department for Registration. We quickly would have to ensure that the right thing is done to register with the Registrar General's Department, and as well for us to go ahead and collect the tax, and rigorous investigation will go into it to ensure that the assertion and the claim or the claims are actually what it is, and we would make sure that the right taxes are collected.
Okay, maybe Godwin and Yvonne, do you have any follow-up here? And before you come in, so can you share the process? So if I am a multinational now, and I know I have maybe triggered the corporate tax residence, but it's just going to be for just 1 year of assessment. I do not want to go through all the hassle of having to register and then now go to GRA, show my documentation for a file to be open, get an account, and now go to the portal. What do I do? Where do I go to just comply with that year of assessment, just that compliance? What should I do? Mr. Noah, you'll be able to assist.
Sorry, I didn't get the question.
Okay, so I think Michael just shared that if it's just maybe just 1 year of assessment and you need to comply, there is an avenue where you can actually honor your tax compliance obligation without necessarily having to register an external company here. So I wanted to understand the process. So if I am a multinational now, I'm ready to make these payments to comply. Where do I go to, or where do I start from?
Okay, the starting point is GRA generally. You go to the GRA office. In fact, right now there's the portal. You can actually do the work on the portal. Let's see which is the easiest way. I think the best thing would be to get to the nearest GRA office or check from there. So the client service center, then they'll give you the best direction. Because I say you might be non-resident. There's some income tax you need to pay. You don't have a TIN, so you can't go onto the portal and file a TIN. The next one would be to then work through the GRA office, which means you need to talk to the client service center. They will give you the directions as to how you can best make the payment. If it happens that you be registered in terms of the e-commerce, you'll be registered for VAT, then automatically it means you have a TIN, and so you can then use that avenue to make the payments you have to make. But if you don't have any presence at all, any registration status at all, there's a need to make a payment. And then it's best to talk to the GRA client service, who will direct you to whichever office you should deal with. At least that's what I can say offered. But I don't know whether Michael wants to.
Yeah.
Yeah.
Michael, yes, okay.
Yeah. So basically, that's the procedure. The first recourse should be to our client service centers, and they will proceed from there, direct you on how to register. You can also approach through the online portal. And if you have any challenge or difficulties, you can you may consult our customer care hotlines, and we are glad to assist you in all areas. But our client service center are set up to ensure that every difficulty that you encounter, once you walk through there, they would assist you, whether it is IT related or in terms of legislation, misunderstanding, or whatever the issue is, it will be duly addressed for you to conveniently pay your taxes. Thank you.
Thank you, Michael. Godwin, any follow-up from you?
Well, it's not a follow-up, but an additional request that I think is very essential for the ease of doing business in Ghana. When we've spoken about the permanent establishment creation, Mr. Noel did indicate how complex, the interpretation can be. But Ghana, we do not have a lot of literature, when it comes to Ghanaian literature on what the Revenue Authority, or from a policy perspective, what the Ministry of Finance tax policy unit would consider to be things like place of business, carrying on of business. But we do pick some of these things from the OECD commentaries. So it will be something that would be very important if we can develop a local policy. Yes, until now, we didn't have any policy on how to apply for DTAs in benefits in Ghana, but now we have that. So it is something that if the tax policy unit can also take up to develop a policy manual around that, because as the discussions has been going, it is clear that one of the easiest ways that one can unintentionally create a tax residence in Ghana is through this permanent establishment.
Okay, thank you, Michael. So maybe we can talk more on the double tax treaties. Currently, I think I mentioned that we have 14. So maybe to Mr. Noah, are there plans on adding on to the 14 that we already have? Because I think businesses have expanded. We have more interactions with more countries, and it would be great if businesses can reduce their double tax exposure.
Okay, thank you, Christiana. And I think I made a statement earlier. Let me actually repeat it now. You can still get the foreign tax credit even if there's no tax, there's no double taxation agreement between the two countries. And I'm sure some of my colleagues are here on, they can correct me if I'm wrong. Almost 99% of countries or states that are worldwide have the foreign tax credit system. Yes, of course, as I mentioned, different. In some places, you get the credit as a deduction in addition to expenses. In some of the cases like Ghana, you get the actual tax being deducted from the tax. So if your tax, Ghana, our tax rate, standard tax rate is 25%. You pay the 25% in Ghana, and you go to your jurisdiction. Either you be allowed that 25%, especially if it's more than, or if it's equivalent to Ghana, 25% means you won't pay any tax there. If theirs is 35%, it means they will take out, they'll compute the 35%, take out the 25% you paid in Ghana. The difference is what you pay there. If it's the corporate rate is less than Ghana, it's 20%, then they'll just take the 20%, the 5% you paid is tax. As I mentioned, you have to be taxed somewhere there. So there'll be some tax on it. Now, when it comes to the DTUs in general, yes, we have 14 that we signed and are enforced. We have 6 of them that are pending ratification. So we have signed, those have been signed, but you have to go through the system and get parliamentary ratification. We have 5 of them which are still being negotiated. So there's Hungary, Israel, UAE, Korea, Egypt. They are under the process of being negotiated. We have another 5 which have been initialed, but they've not been signed. So we concluded, but we haven't signed yet. We have about 3 of them which we are renegotiating, because we negotiated them quite a while back, some more than 20 years ago, but they were not signed, or they were not signed and have not been ratified. Things have changed. So basically, the various models have changed over the period. In addition, so we need to renegotiate them and bring them up to date before we can work on them. Then we have another 3 which we've had discussions on, but we are yet to start. So there are a few more in the pipeline, about 2 or 4 others, which we are still in the process of discussing when we start. So so there's quite a number. There's about 36 of them, if you are including those that which are included.
Okay.
Now, what I want to suggest, and we've done some work on DTs. What I would like to suggest that if you want to look at our model, or you want to look at how things work with us in terms of DTs, and you want a commentary you want to use in the absence of what we have, the best one to use is the UN model convention commentary. We have departed from what the OECD uses. Though if you pick our treaty, our model treaty, you find out that we have a hybrid. We've picked things here and there. But generally, yes, you can look at the OECD commentary, but our commentary will be closer to what the UN model provides, because that's what's looking at a lot of the developing countries, and that's what the basis for most of the things that we do. So that you realize that there are slight differences in some of the ways some of the things are looked at in both countries. So that is, I'm not saying that you can't look at the OECD commentary. You can look at it, see what it is, but look at what the UN commentary says too, because the UN commentary will be closer to the way we look at things than the OECD one. Thank you.
Okay, thank you. In that same direction, just to find out where a multinational or a taxpayer has an issue or a dispute, in terms of the mutual agreement, who must initiate the discussions, because it has to do with 2 jurisdictions.
Okay, so the place where you start with is your jurisdiction, so your competent authority. You will raise the issue with your competent authority, who will then raise the issue with the Ghanaian competent authority. That's in our case, the GRE. Then the two will sit down and look at the issues and what pertains in terms of, okay, so this person is registered here, and where effective management is here. Now we are looking at the PE rules that we have. These are the PE rules that we have in the DT. So where does the person fall within this? So all those things, but you will tell your competent authority, indicating everything in relation to the situation. Then your competent authority will form the Ghana competent authority. Then the two of them will sit down, thrash it out, and at the end of the day, come out with what the decision is.
Okay. So just to remind our audience, today's webinar is made possible by UK GCC. Keep on posting into the chat box if you have any questions, and we will ensure that those questions are answered. Okay, so I think this goes to Mr. Nia. Someone wants to know, I just want to confirm, Mr. Nua said we should rather look at the UN model comments and the OECD comments. Okay, correct. It was a bit unclear. Okay, so yeah, confirmed. So he mentioned that we need to, when it comes to the commentary, we need to look at the UN model if we want details on what the OECD article and section is talking about. Okay. Yvonne, any comments from your end?
Yes, when Mr. Noah spoke about the place of control and management, I wanted to add something to what he said. So even though the law doesn't define where place of control and management is, I think as organizations, you should look at where do you make your commercial or policy or business policy decisions? Where do you take decisions that affects the direction of the company? So for instance, you have different business lines, you want to close one line and you make the decision in Ghana, that's control. So for you to be able to be identified, or for you to be identified in Ghana as a PE or as a resident corporate body for tax purposes, you should look at where you take your commercial decisions. How does it affect the business? So that's what I wanted to key in, that even though the law doesn't define it, you should look at it from that perspective as well.
Yvonne, thank you. So I think, Michael, in terms of compliance, a company's tax obligations, how does the change in residency status affect their tax obligations and compliance as a whole?
Okay, thank you. So under the tax law, we look at realization. Now, if a change in status or an entity or a company changes its residential status, then it will be deemed that it has closed its activities within Ghana and the assets and liabilities would have been realized. And we will use regulations under the Act to ensure that all taxes that are due up until that point are actually collected, and any other assets that accrued either gains would also be taxed accordingly. And from there, we would monitor to ensure that, yes, the change that has been communicated, that is either the company has closed down in Ghana and has actually relocated elsewhere, is what it is. And that will be what the procedure will be in the GRA.
Okay, so I guess that will include audit.
Yes, there would be a cessation audit at the point that the company would inform GRA or Commissioner General about its intent. Then the cessation audit will be conducted. It's quite elaborate to ensure that the entity will not disappear with any tax revenue thereof.
Okay, thank you. So to my audience, please feel free to raise your hand if you have any questions and you want to ask them yourself. If you don't, you can also put your questions in the chat box. Let me go back to Godwin. Godwin, again, from the lens of your client or the multinational, is there any particular challenge when it comes to compliance where corporate tax residents have been triggered?
Well, I think the challenge you did mention that to go back to the registrar of companies to register an entity before registering with the revenue authority, and the additional compliance, as Michael did indicate. And assuming it is just a one-off business transaction that has created a permanent establishment in Ghana, maybe a transaction that would take, say, 3 months or 6 months. After that, to go through all the processes of deregistration, the GRA would have to do a tax audit to clear that you do not owe any taxes. So this is something that we do not. I know in some commentaries, you may have like 6 months for the creation of a P. Ghana, we appear not to have something like that. Maybe Mr. Noe can clarify that, but reading through our law, apart from where you are doing, the minimum we have is for 90 days for construction and those other related activities. So if you are coming to do something in Ghana for just 1 month, 2 months, and it creates a permanent establishment, it is a lot of compliance obligations that you have in Ghana for such a short duration of time. So that is one of the challenges that are usually encountered when it comes to these compliance requirements in Ghana.
Okay, thank you. I have some questions from our chat box. Maybe Mr. Noah, you can touch on Godwin's challenge. But one of the questions we have is they want to understand the process to get the foreign tax credit applied to an entity's corporate tax liabilities once you receive the tax certificate from the foreign entity. Would it be Michael or Mr. Noah?
Michael can answer that.
Okay.
Okay, so in the procedure of claiming your tax credits, let me start from where the person is now making the application. So for DTA, you need to complete a certificate of residence properly endorsed by the jurisdiction. And based on that, the tax credit certificate or its equivalent from that jurisdiction would be attached and submitted to the TSA or the tax office where your tax case is being handled. Based on that, the schedule officer would analyze and complete the necessary procedures to accord you the granting of that credit. If it is through a tax audit, same will be followed to honor the rights of the taxpayer to the claimant. Yeah.
Okay. I have another question. It says, to benefit from any double tax treaty relief, who do we need to submit an application to with reference to the recent practice note that was issued?
Well, Michael, go ahead. I mean, you are the practitioner.
Yeah, please, can you repeat the question for me? Sorry.
That to benefit from any double tax treaty relief, who do we need to submit an application to with reference to the recent practice note that was issued?
Okay, so the residence certificates, as I mentioned, having been completed, would be forwarded to Commissioner DTID, and the necessary checks and engagement with the partner jurisdiction will be conducted to ensure that there is no treaty shopping and all the other qualifiers for a treaty benefit has been satisfied, based on which an advice will be given to the area office or the TSC that is handling the case or audit, and it will be adjusted as such to the tax ledger of the taxpayer. Thank you.
Just as a follow-on to the benefits for our audience, how many days will it take once an application has been put in to receive a response?
Yes, GRA has a standard of 30 days to ensure that the rights is honored or the treaty benefit is accordingly granted to the taxpayer.
Let me put a caveat in here, Christian. Now, let's know that we will write to the other jurisdiction for confirmation. So it's when that confirmation comes in that the 30 days starts. Because without the confirmation, we can't process it. We will need to confirm from the other state that you are a resident of that other state. And that, in that case, you qualify. Then we can start the process of working on giving you the credit. I hope that one is clear. Because if we say 30 days and it goes to the other jurisdiction and they spend 30 days in getting back to us, there was one which recently we started working on. That took about 3 months before we got a response. The 30 days will be out of work. So the 30 days is from when we get the information from the jurisdiction, the other jurisdiction, or the other competent authority, then we can start the process. We can do all the other things, but we need to get that confirmation.
Okay, thank you, Mr. Noah. And this is still on the foreign tax credits. So the other thing wants to know, can you make a case on the tax portal instead of writing a letter to the tax office?
Yes, the tax portal has been configured and it's more or less the tax office. So engagement in respect of all these things can take place there, and you would upload the necessary attachments for necessary review to be conducted. So we can initiate it from the tax portal.
So audience, please be reminded that we are still in the Q&A session. So please feel free to raise your hand if you want to ask a question or put your questions in the chat box. Okay, so I know we've spoken about the PE creation, how it's linked to management and control. Just to look at it from the individual angle, maybe Mr. Noah, if you can throw some light on the activities of the individual that can trigger corporate tax residents or PE for the entity for Ghana corporate tax residents purposes.
No, Christian, I thought you were going to say.
Yes, I was going to say that before you answer, since it is still on the double tax treaty, I wanted to chip in this question from the audience before you answer the individual bits. Is that okay?
Okay, that's fine. Yes.
Yes. So an individual wants to know, will the GRA need to communicate with all the foreign competent authorities for all double tax treaty relief? For instance, a reduced withholding tax rate will the GRA have to reach out to the foreign competent authority? Or if a tax resident certificate is obtained from the other competent authority?
Okay, so let me start with that. Now, for the foreign tax credit, basically, you would have, yes, you might bring a certificate from the other jurisdiction, but GRA would need to confirm and be sure that that was issued by the unfortunate thing is that people can be mischievous. So though you brought a document, you need to certify the document. So we'll still need to contact the other authority and be sure. So whether it's a reduced withholding tax or it's full or whatever liability it is, we need to contact. I mean, that's the way the system works. Now, for individuals is an interesting format because the tax rate for resident individuals is different for the tax rate for resident individuals. Resident individuals will use the shadow bearing personal income tax schedule, which is the graduated rate, whereas the rate for non-resident person individual is a flat rate, basically like withholding tax. So it's not graduated. Now, for an individual to be resident, and normally will determine who is resident, the fallback is that if you are not resident, you are not resident, you are not resident. And so for the resident individual one, the person should
Mr. Noah.
Yes.
Sorry, just a quick one. We have two questions. One from Louisa, still on the on the withholding tax, double tax duty. So the question is, if for instance, I am paying a South African entity and I am fully aware of the rate that applies to withholding on goods, can I go ahead and apply those rates, or the tax residency certificate must be provided before I can apply the rates in the treaties? Mr. Noah or Michael? Oh, yeah.
Okay, let me allow Michael to answer. He is in practice. Yes, sometimes I've heard the GRA answering because they are the ones who do. I might say something. Listen, so Michael, I think you can take on that.
Thank you, Mr. Na. So to avoid the temptation of granting the treaty benefit to a treaty shopper, we need to do the confirmations, as Mr. Na rightly stated. And this transaction from South Africa, once the application and the details are brought to GRA, we will then confirm with SA to ensure that the company in contention is actually tax resident of South Africa. And with that, GRA would write to the person who asked this question or the Ghanaian company dealing with the SA, through which we would then affirm the rate that is applicable. And with these documents that has been handed over to the Ghanaian entity dealing with the SA entity, it will aid in audit procedures to confirm that, yes, their decision to apply a lower rate was actually what it should have been. Otherwise, there will be gaps and bridging it will be difficult. And GRA is always the route through which such confirmations should be done before you can conclude it. Thank you.
Okay, so a follow-up from that. So the new policy, whilst it is understandable, hampers business activity. So I think the proposal is, why not put in a requirement to...
Let me answer. I think the policy is not a new policy. The procedure is standard. I tapped in. I think that's why it's moved out. Okay, it's a standard for policy. I mean, if you decide to go ahead and there's a problem later on, you should realize that you will be liable. That's what the first entity should understand. Now, Michael mentioned something. We have what we call limitation of benefit clauses. It's in our law, where he used the word treaty shopping, where sometimes people sign treaties, then they don't have a presence, a proper presence, let me put it up, in the country. They're just there as a shell. They go and register in that country because they want to take advantage of the DTA. But they are not really resident in that country and doing work in that country. So all these things are looked at to ensure that the person really deserves to get the benefits of the double taxation agreement. That's where the issue crops in. So that we avoid this issue where, as I mentioned earlier, some people can be mischievous or they arrange their things like that. They want to avoid that. I won't use the word, but avoid tax. And so some of these things are there to make sure that you, the entity that you are withholding or you're making the payment on their behalf, you don't get shortchanged. Because if we find out that they are not entitled to the benefit, it means you, the person who made the payment to them and they not withhold properly, will have to make up the difference. So it's a protection for both the entity and the revenue authority.
Okay, so I think the recommendation was that why don't you allow it to go through, and then during an audit that will come up. So maybe by then you would have responded to them.
Yeah, what I'm saying is that the danger that it poses is that if it happens that the person doesn't qualify, it might be possible for you to recover from the person. But if you can't recover from the person, it means the GRA will recover the amount from you, the entity that made the payment. That's the portion I'm giving people, because a lot of people do it and then get a residency later on. Yes, I mean that's not the process, but that's what has been done. And then we audit. But the question too is that before we do the audit, if we don't audit you for a few years, what it means that you would have been doing the loans, you would have accumulated debts. The country will also not have had the benefit of the taxes to do the things it needs to do. And you will pay with the necessary interest and other things that we want to avoid that situation.
Okay.
Yeah. Then to the substantial question you asked me on the individuals, I know our time. For a person to be resident, the person must be a citizen. First one is if the person is a citizen of Ghana and has a permanent abode or does not have a permanent abode here. So if his permanent home is outside Ghana, though he's a citizen, we will look at it differently. He will be more looked at more as a non-resident. But that means he's personal abode for the whole year, not part of the year. Now, where a person was also in Ghana for an aggregate of 183 days within any 12-month period, the person is considered to be resident. Our officials in foreign missions are also considered to be resident in Ghana. Okay, so that's where the issue is. But if you are also absent for 365 days, yet you have a permanent home in Ghana, then you are still considered resident. So let's assume that I decide I want to go and do an MBA or some course outside Ghana, but my home is in Ghana, out there just to do the course or some medical treatment or something that I'm still considered to be a resident person because my permanent home is in Ghana. I'm out there temporarily, even doing more than a year. So those are the things the individual needs to look at. So if you are an expatriate and you're in this country for the whole year, you are considered to earn income unless you are working for a foreign mission or an international organization which is considered as non-resident. Then you are resident in Ghana. You are resident in Ghana. If you're a foreign consultant and you come and do some business here, now you may not be considered as resident, but know that you still pay tax because you pay tax as a non-resident because the income you would have been and made while you are in Ghana. The other thing,
Yeah, Mr. Noah, Mr. Noah, I can see you are fired too, but time
all right.
is
So
up. Maybe I think the Well, as I mentioned, it will have to be a whole session for that, because when it comes to the individual, there are a lot of things to discuss. There's still quite a number of questions on in the chat box regarding the withholding tax and applying the double tax treaty. So to audience, we will try as much as possible to answer your questions in the chat box. So Mr. Noah and Michael, if you can assist with that. So with that said, I say that our time is up, and I want to first say a very big thank you to UK GCC for making this happen. And again, if you log on to their website, you'll be able to see all the fantastic things that they are doing and how they can support you as a business. Log on there to know more, and if you wish to join, please follow through and look at the joining requirements. I also want to say a very big thank you to my panelists. Thank you very much for dedicating your time with us today. The discussions were very insightful, and we know that when next the UK GCC come knocking at your doors, you'll be very happy to collaborate on series such as this in the future. Finally, a very special thank you to our audience. Your questions and comments were also very thoughtful and spot on. We really appreciate your time and contributions. Thank you all once again, and enjoy the rest of the day.